Hey, this is Justin with daytradethemarkets.com. It is October 4th, the evening of October 4th, and I thought I would look at an example today from this morning in gold. We were talking about this during our live member session this morning. I thought it was a good example of the decision-making process that you want to think about when you're taking a trade so that you know that you have a pretty good edge. And I think just a little bit of background, I've learned over time and in working with a lot of people that most of us have probably learned, or we think about trading in terms of trade setups. You know, if rule A and then in rule B and then rule C happen, we take our trade. And that makes sense that we would want to think that way. The problem is that it rarely works out very well in the long run doing it that way. What I have found over the years that was really the turning point for me is when you stop thinking about your trade setup and you instead start to think about making sense of the market first, then the trade setups fit into that context. So if you can identify what the market is most likely to do, you're still no guarantee you're going to make a trade that's going to be perfect. But if you have a pretty good handle on what the market's likely to do, you can get your money in well. You can put yourself in good positions more often than not. And that's really all we have to do as traders is get our money in right, okay? Get our risk allocated in smart situations. And so that all makes good sense, and that certainly would, I suppose intellectually that makes sense. But the next step then is, how do you go about making sense of the market? And can you do it in a way that's more than just luck? Can you do it in a repeatable fashion? And so that's what I wanted to talk about today. And the way that I teach this, the way that I trade, the way that I look at this is kind of a three-step process, or a three pieces of evidence process. And you can certainly add more pieces of evidence if you have them. But I look at three pieces of evidence, and they are: first, big picture analysis, okay? That's something that's known before the day starts. That's our longer term analysis, okay? And heading into today in gold, our big picture bias was down. We also have what I call zones, or they're kind of intermediate term analysis. These are support resistance areas, okay? These are also known before the day begins. And today, the one we were dealing with mainly in gold was right here in the color gold as well, in this kind of yellow area here from here to here, okay? So that's a known area ahead of time. And then the third one is formed during the day, throughout the day, and multiple boxes typically form. But these are short-term analysis, and this is the way that we really get a handle on what's going on short-term within the day. You can see one of these here early in gold here was formed. It was a selling box. And so the idea here is if we can get two of these three in line, we've got an edge, okay? If we can get three of the three in line, we've got a very strong edge. We've got a really good trade. Again, edge doesn't mean guarantee. You're not going to hit 100% on this, but you do have a very good edge when you get 3 out of 3. And so the reason I wanted to talk about the gold is because it gave a really good example, and this is one that we talked about live today. And so let's kind of go over what it's telling us. I stopped the chart here at 9:08, and we'll run it forward a little bit. This is Eastern time. But what we have here, and I like to do what I call a status at any moment in time, because that's the repeatable part. At any moment in time, you can say, okay, what are my evidence points telling me? Do I have 2 out of 3, or do I have 3 out of 3? And if you've got 2 or 3 out of 3, you know you have a situation where you have an edge, okay? And we can look to get into the market. We can look to see how much risk would be reasonable relative to the situation that we're dealing with, okay? So at this very moment in time, what do we have? We have a situation where the big picture bias is down. I like to just kind of, I like to kind of call it a status. And this is the repeatable part. So our big picture bias, okay, is down. We know that. And that's clearly bearish, okay? Now on the zone level, we are below, below the zone. We're below that resistance area, okay? That is bearish. We're not in between it. We're not above it. We're below it. That's bearish. And on our box level, we have a selling box, okay? That is bearish. So what is that telling us? It's telling us at this moment in time, we have a pretty good edge. We've got 3 out of 3. 1, 2, 3. We need to find a way to get short, okay? And so doesn't guarantee it's going to work, but we know that we have a pretty good edge, and if we put some risk on the table at this point, we have a pretty good opportunity of getting a return. So now the next question is, where do you get in? And I look at this a little bit differently than most people as well. Instead of just thinking purely about trade setups, I like to do what I call reverse engineer a trade. So I start with, where am I wrong? Okay, where am I wrong? And in this case, we would be wrong on 2 different levels if the market starts to get comfortable back above here. Because number one, it should, once the selling box forms, if it comes up here, it should find resistance. Okay, if the market starts to trade above that selling box, that's not a great sign. Same thing with this zone. Now that we're below this zone, if it comes back up and tests that zone, it should give resistance, and it really shouldn't trade back up in here. So that we know that we're wrong somewhere back inside of that zone and somewhere above this box. Therefore, we know that our stop can be placed a few ticks above the high of that. Okay, so then we say, how much risk do we want to take? If you want to take very little risk, you can get in about right there. If you want to take on a little bit more risk, you can get in about the 50% retracement of this box. Now, this would be a situation if you're ever going to take on more risk, because again, it's kind of 3 out of 3. This would be one of those situations. Okay. Now, the perfect, extremely low risk trade, extremely high reward expectation would be if we waited for a test up to here to the high of the box, the low of the zone, to get short right there. But again, when it's this bearish, sometimes the risk is trying to keep, it's actually riskier to try to keep your risk very, very tight. The opportunity is worthy of more risk. So, getting in around the 50% retracement of the box makes a lot of sense. And, there was an opportunity right in there, right here, where it decelerated, where it's a pretty good opportunity to get short right in that area. Okay. So like we were talking about in our session, let's say we get short right in here. Okay. Our stop is somewhere up in here. What's our expectation? Our expectation is that the market should be able to test the low of this box, and if sellers are strong, this will be a good barometer. They should be able to get below there, and then we want to just take that thing down as far as we can take it until evidence changes. Okay, and so our next level down is here around 1272. That would kind of be our ideal or our full expectation, but that's just kind of what we're looking for. So we kind of play this out here. We test below it, can't quite get below, but we're not back above it. And then we really break down much lower here. And at this point, you're just saying, okay, we're in a vertical move. This is what we're looking for. Let's stay short until the evidence changes. Okay, so another nice move lower. Now here's a little bit of a challenge. We had these extreme selling bars that came in. Okay, now here we get a strong buying bar off of the low. This is saying that the buyers are trying to step in. Now it's possible it turns right back around and keeps selling off, but if we start to trade above this green bar, that's telling us, okay, this move has probably come to an end, at least for right now. We might get another move later, but it's probably come to an end. That's basically what happens in here. So I just wanted to show the decision. It's not so much, oh, great, it was a winning trade, or, hey, look at that one. You can always cherry pick good trades. That's not the point. That doesn't do anyone any good when you just cherry pick trades. The point is, and I can show you plenty of trades that don't work out that have edge, okay? But the point is, when you have a repeatable process, you're giving yourself a really good chance to be successful. And that's the point I'm trying to make with the video tonight. So I hope that makes sense. Let me know if you have any questions on that, and we'll talk soon. Thanks.